So, big question for you today. When do you sell your stocks? And more precisely, when do you sell a winner in your portfolio? So, a stock that is up 25, 50, 100%? Do you have a set limit to lock in your profit and run like a bandit? Or do you let it run forever? I personally tend to keep my winners for a very long time, but I do have specific investment rules. And the thing is, sometimes it forces me to sell a stock that is up big time in my portfolio, and it's almost against my lizard brain that keeps on telling me old did it with diamond ends. So in February, I had to sell BlackRock for a great profit of 165%. I've been holding the stock since 2017, but came to the conclusion that it's not a good fit for my portfolio anymore. So today I'm going to walk you through my thought process when I bought BlackRock in 2017 and what made me sell it not too long ago for a hefty profit. So let's go back in time and see what was my investment thesis when I looked at BlackRock back then. So BlackRock, so you know, it is the world's largest asset manager. They sell ETF, they sell investment solutions, and they also go with both institutional and retail clients. They have multiple styles, they offer all kinds of products, and they do it in a way so they can earn a lot of money. So the way that asset manager does it is they generate a lot of revenue based on their assets under management. They're just charging a fee on that, which is great when you look at BlackRock, especially the recent year, for example, is the company is able to attract more investors year over year. So when you have this kind of business, one key metric is to track the net inflow. The net inflow is not just the market fluctuation affecting the assets under management, but more importantly, the cash flow that goes into those funds minus the cash flow that goes out of those funds. So the ins and the outs that will bring you to the net inflows. As you can see, BlackRock is always able to grow its assets under management, not only to rely on the stock market, but also at the same time to attract new investors. Another thing that I've loved back then is the stickiness of this business model. A lot of investors do not tend to switch from one product to another, especially institutional clients. Institutional clients are like banks, investment firms, pension fund. They will not fire their portfolio manager every 3 months, right? And with 75% of their revenue coming from base fees, it means that they are just on a recurring money printing machine all the time. So this was true in 2017, and it is still true today. World's largest asset manager, continuing to increase its inflows, generating a very recurring source of income. And on top of that, they also have built Aladdin. So Aladdin is the platform that helps professional portfolio managers to manage their risk, and that increase the level of stickiness to their business model. So what's the problem, right? Everything seems great. The stock price is going up. Investors are super happy to hold BlackRock. So what is the problem with this one? Well, every quarter, I review each of my holdings. And one thing that I do is I focus on their dividend triangle. The key here is to ensure that a company like BlackRock continue to generate higher revenue, higher earning per shares, and of course that it continues to grow its dividend. When you look at the current dividend triangle for this company, it's normal. You see it goes down, it goes up, especially for revenue and for earnings. So we had like between mid 2018 until 2021, that was a little bit of a rough patch, then a growth phase, and then another rough patch between 22 and 24. And now we're still back in growth mode. When you look at the stock price, it's pretty much the same story. So why in the world I decided to sell such a great company? Well, if you look at the latest part of that dividend triangle, it shows you the dividend increases, and you can see that it was amazing back when I bought it in 2017, not so much right now. One thing I want to highlight when you do those kinds of analysis is to look at the 5-year numbers and then take for granted that it's the good average. So for this example, if you look at this graph, you see the 5 years dividend growth showing a dividend increase of 43.5%. So on 5 years, that makes an annualized growth rate of 7.5. High single digit grower. This is the type of company I want in my portfolio. The problem is, if you narrow down and zoom in into the past 3 years, the dividend only increased by 6.7%, which is the equivalent of a dividend growth rate of 2.2%, which is exactly what we got over the past 3 years. Quite disappointing. So when my lizard brain look at the total return for BlackRock, it's going up, and right now it's on a very solid trend since the beginning of 2024. So we've been more than 12 months going up and up and up, and then my lizard brain is telling me just keep on riding. But the thing is, I have investment rules in place to protect my portfolio against myself. It's very tempting to keep this kind of company. And you know what? The investment thesis is still intact, so I have no concern about BlackRock continuing to grow and to perform on the stock market moving forward. So why in the world am I selling? Because my strategy evolves around low yield, high growth stocks. So I need companies that shows a high dividend growth rate. So at least 5%, ideally high single digit, and in a perfect world, double digit dividend grower. With a 2% dividend increase, I had to set the bar a little bit lower for this one, right? So what happened is after the first increase of 2%, I said, okay, the management is being conservative. That's all right. I can wait a little bit more. The second year, I thought, well, this is getting annoying. And then it went on my watch list to potentially sell it. And eventually, as I discussed with my Dividend Stocks Rock member for a while, this one was on my watch list until the beginning of 2025, when I had the confirmation that the next dividend increase would be the same, which was roughly 2%. This is too low to my liking. This is not aligned with my strategy. And for that reason, it's time for me to sell and move on. Maybe I'm going to regret it in terms of I'm fairly confident that BlackRock will continue to grow moving forward. But if I'm not 100% aligned with my strategy, I cannot invest with conviction. And investing with conviction is more important than anything else. After all, cashing that profit is not the worst thing that could have happened to me anyway. So I decided to sell, and then I'm going to use the Rockstar list to find my next replacement. The Rockstar list is quite simple. It's a list of stocks that I've built using the Dividend Stocks Rock stock screener with a filter using a positive revenue, earnings per share, and dividend growth rate over the past 5 years. I will start to narrow down with strong financial metrics, and then I'm going to dig a little bit deeper to find which company has the best investment story to sell. And then once I have a strong investment thesis and a robust financial metrics, I will be able to buy again another stock from our portfolio. So if you want to start your research, you can actually use the Rockstar list that is being updated monthly through my newsletter. So you can go at dividendstocksrock.com/rockstar. You'll be able to download the latest issue, and every month we're going to send you a new one. If you're already a DSR member, well, you can load up the Rockstar list whenever you want and add multiple other filters and columns to refine your research. All right, guys, that's enough for today. I am curious to know if you would have kept BlackRock in your portfolio or not. Let me know in the comment. Do not forget to subscribe to the channel to not miss my next video next Thursday. That will be about Canadian banks. So subscribe to the channel. Give me a like on this one. And until the next video next Thursday, don't forget to stay invested.